Today, we're diving into a fascinating stock that's been making headlines recently. I am talking about Enbridge, ticker symbol ENB. For those who might not be familiar, let me give you a quick overview of Enbridge. Enbridge stands as a prominent Canadian energy infrastructure firm, structured around four core business segments: liquids pipelines, natural gas pipelines, gas utilities and storage, and renewable energy. With an extensive presence in the energy transport sector, Enbridge plays a vital role, facilitating the movement of approximately 30% of North America's crude oil production, and around 65% of US and Canadian oil output. Additionally, they serve as a conduit for roughly 20% of all natural gas consumption in the United States, boasting an extensive midstream network spanning over 73,000 miles across North America and the Gulf of Mexico. In the sector of renewable energy, Enbridge's portfolio encompasses a network of wind turbines and solar panels that generate green energy sufficient to power approximately 966,000 homes. Established in 1949 and headquartered in Calgary, this company has cultivated a rich history of steadfast performance and harbors promising growth prospects for the future. What sets Enbridge apart, especially in turbulent economic times, is its status as an energy stock, known for its defensive nature and robust revenue and cash flow streams across a wide spectrum of economic conditions. As evident from their investor presentation, Enbridge's lower-risk business model has withstood significant trials, including the 2008 financial crisis, the 2015 commodity market collapse, the 2016 Fort McMurray wildfires, and the challenges posed by the COVID-19 pandemic. With this resilience and stability, Enbridge has positioned itself as a notable player in the energy sector, making it an intriguing investment option, particularly for those concerned about economic downturns. Enbridge has been making some significant moves in the energy sector. Over the years, they've been shifting their portfolio away from dirtier energy sources toward cleaner ones, aligning with the global transition towards sustainability. So what's the buzz about Enbridge? Recently, they announced a massive deal to acquire 3 natural gas utilities from Dominion Energy for a staggering $14 billion. This includes a hefty $9.4 billion in cash and approximately $4.6 billion in assumed debt. This move is aimed at increasing their presence in the natural gas sector. However, here's where it gets interesting. Investors reacted to this news, and Enbridge's stock experienced a dip of up to 6.7% in response. So, what's causing the hesitation? Well, there are a few concerns that some investors have expressed. One concern is that Enbridge might still be too reliant on carbon-based fuels in a world that's rapidly moving towards renewable and cleaner energy sources. This acquisition doesn't necessarily change that narrative. But it's crucial to understand that natural gas is often seen as a transition fuel that helps bridge the gap towards a more sustainable future. Enbridge is essentially making a bet that these natural gas utilities will generate steady cash flows while the global energy transition continues to unfold. It's a prudent bet, considering the gradual pace at which governments are working towards cleaner energy goals. The transition to a cleaner energy infrastructure is a complex process that takes time. Another aspect to consider is Enbridge's long-term growth target, aiming for around 5% in distributable cash flow. This acquisition might not drastically alter short-term expectations, but it does add regulated utility businesses with clear spending and growth outlooks. This enhances the appeal of Enbridge's track record of consistently growing dividends. To make this acquisition happen, Enbridge is expected to issue stock, a common practice in acquisitions. This move helps them maintain their financial strength without overextending themselves. Although there's always the risk of shareholder dilution when new stock is issued, Enbridge appears to be approaching this cautiously to capitalize on a unique opportunity. In some ways, Enbridge is adopting a somewhat contrarian perspective on the energy transition. They're essentially betting that the shift to cleaner energy will be gradual and that natural gas will remain a profitable investment for the long term. With a focus on providing investors with a reliable and high-yield dividend, this acquisition seems like a well-thought-out move. So what's the verdict? Enbridge's decision to expand its natural gas exposure is part of a broader strategy aligning with global energy trends. While some investors might have reservations, it's important to remember that investing is a long-term game. Enbridge is positioning itself for the future, and if you're on the lookout for a dependable, high-yield dividend stock, this recent development could present an appealing opportunity. If you found this breakdown helpful, please give this video a thumbs up and subscribe to the channel. And as always, remember to conduct your research and due diligence before making any investment decisions. Thanks for joining us today. Till next time, take care.